My name is Michael Episcope, and I'd like to welcome you to this webinar. I'm one of the co-founders and principals at Origin Investments. Thank you for your interest in the Origin QOZ Fund. The goal of this webinar is to make sure that every individual who listens walks away with a clear understanding of why Origin is uniquely positioned to succeed in this space, how the fund works, and how you can participate. The webinar will follow the outline starting with about Origin, why QOZ and why now. I'll talk about the fund strategy, the capital call process, to which we get a lot of questions about, and then I'll go over a deal-by-deal analysis to highlight the tax benefits of QOZ investing and compare that to a non-QOZ investment to highlight why this program is so advantageous. I'll then talk about the fund return projections and finally close with the terms and fund fees. What I will not be covering is the pipeline or active deals in the fund today. Those are constantly in flux, and if you want information on either one of those items, go to the website and you'll either find the information there or you can schedule a call with your personal Origin representative. Let me start by just giving you a brief overview of Origin as a company. We have 30 team members, we have 4 offices around the country, and we've executed on more than $1 billion of assets over the last 10 years. And we currently serve the needs of more than 800 investment partners across our various funds. For the last 10 years, we've focused on investing primarily in the multifamily sector, but have also done a fair share of investing in the office, the retail, and the industrial sectors. We've never had a loss in any of our funds, and we were recently honored by Preqin, a third-party provider of fund management ratings, as being one of the most consistent, top-performing managers in the space. I would characterize our investment philosophy as being value-oriented. We've traditionally focused on emerging neighborhoods, transitioning neighborhoods in some of the fastest growing cities in the United States, places like Denver, Charlotte, Austin, and Atlanta, just to name a few. We are in a total of 11 markets today, and all of those 11 markets fall within the top 15 growth markets within the U.S., and we will continue to look for QOZ deals in those markets. Why QOZ and why now? What we know on the face is that the QOZ tax benefits are incredibly favorable for the investor and probably the best tax breaks we will ever see in our lifetime. And that's what really got us interested from a personal standpoint in this law. My partner and I saw this as a means to potentially maximize our after-tax returns and those of thousands of other investors. Before we launched our fund, we had to answer one simple question. Can we execute? Can we find enough deals is probably one of the most important questions, right? Can we buy them at the right price? Do we have the capability to execute on these deals? Are these in areas where we can make money, or are they places that are truly distressed? What we came to discover very quickly here is that our strategy perfectly overlapped with QOZ investment strategy. We were already looking at QOZ deals for Fund 3, and we didn't even know it because the law hadn't been enacted till 2018. And many of the deals in Fund 3 that we both did and we're looking at were already in QOZ areas. This is a really important point I want to make because one of the reasons people shy away from QOZ is the requirement of the fund to invest in economically distressed areas. And that is a reason to be concerned, but not really a reason to run away. It's a reason to do more research and dig further and get to the truth. And we would agree that 90% of the QOZ areas are not economically viable. They are actually truly economically distressed by both our definition and the Census Bureau's. But the sweet spot is finding areas we define as transitioning and transforming neighborhoods, and where the Census Bureau defines these as economically distressed. And it's those areas where you have transitioning neighborhoods that overlay with the QOZ maps where we are looking today and where we were coincidentally looking in the last 2, 3, 5, 7 years in our previous funds. So it was clear to us that our strategy overlapped with a potential QOZ strategy or the ability to execute on a QOZ fund. But also from a fund management strategy, we were aligned. This is our core business. We've raised and deployed 3 funds and have built the company to be able to meet the needs of thousands of investors. We have state-of-the-art proprietary technology. We utilize an outside fund administrator to handle all cash. And we have an in-house investor relations team to answer any and all questions. And what's even more important is that we have an institutionally trained investment management team to go out and execute at the real estate level. The other issue when we talk about executing is making sure we could invest enough capital to have 7 to 10 to even more deals in the fund, because the last thing you want to do is launch a fund and have 2 or 3 orphan assets. So we really asked our team at that time to go out and survey the market and look at it and make sure there was enough depth in their individual markets that we would have runway for at least 12 to 24 months. Prior to launch, we only had anecdotal answers from our team, but they unequivocally said there were plenty of deals to make this fund successful. And what we firmly believed is that first movers would have an advantage. And that's why we ultimately decided to launch the fund in December of 2018. The QOZ strategy is what we call a build to core model. And the QOZ requirements dictate that we have to more than double our cost basis when we buy an asset. And what that means is that if we buy an asset for $30 million, then we have to put another $30 million into the asset or more to comply with QOZ law. So generally what that means is that nearly all QOZ funds are going to be engaging in ground up development. The fund will almost primarily be engaged in ground up multifamily development, but we do have the flexibility to look at other asset classes such as office and industrial. And each asset, when we capitalize the asset, it will take around 2 years to build, another year to lease up, and then we will be holding that asset for 7 or more years. And this is what we mean by a build to core model. We will be going through the ground up development phase, we'll be building the asset, we'll go through the lease up phase, and then we'll be holding a Class A institutional quality core asset for the remainder of the hold period. The chart you see in front of you illustrates the internal rate of return throughout the hold period. And anytime you're adding value to an asset, whether it be in value add or core plus or ground up development, the IRR is always going to be front loaded. And as you move through time, the IRR is going to diminish as that asset becomes more and more stabilized. Now, these risk sets, as we're holding it, are very different, but the reality is that the return profile is commensurate based on where we are in the life cycle of the asset. What you have to keep in mind is that 70% of your hold period is in a core asset. So a 12 to 15% IRR over a 10-year period is more than an adequate risk-adjusted return on any deal given these varying risk profiles. And that return only improves when you layer in the QOZ tax benefits. One of the questions we've gotten from many investors is this a good time for development? And I think we've gotten that question from 70% of the investors who we've met with. And it's a great question, and we certainly have had more than a 9-year run-up in asset prices, and the expected return on deals today is less than it was 5 years ago. But that's really true in every asset class. And what we're seeing today in the marketplace is that deals are still penciling out. There are still opportunities, select opportunities in certain markets and certain submarkets within them. And what we take comfort in is that the fundamentals of real estate, they're still strong, and we're finding deals that do work today. What we also like is that we are investing for the long run in this fund. We're going to be holding these assets for 10 or more years, and these are institutional quality Class A assets. And institutional quality real estate has never lost money over any 10-year period. And that's one thing we like about this fund, is it really does have a long-term investment time horizon. The other advantage of this fund from an investor standpoint is that money will be spread across multiple deals, and every deal will be capitalized 30 to 40% with equities. So there is built-in diversification in the fund. You won't have the idiosyncratic risk that's associated with being in a single deal, and the portfolio diversification really wipes a lot of that single asset risk away. During the hold period, we will be refinancing the assets, and that money will be returned to investors. The assets will also be stabilized, producing cash flow, and to the extent we can return that cash flow to investors, we will as well. So as you're thinking about this investment from a cash flow standpoint, it's not necessarily an investment that's suitable for income investors. But after you're done with that development process, the portfolio in 3 to 4 years should be producing a very stable income stream to investors. Let me go over the capital call process now, because this, again, is probably one of the more complex issues around the law. It's actually very simple for investors, and I think we've made a capital call process that's favorable as well. Unlike a traditional private equity fund that calls your capital over time, we call 100% of your capital at once. We utilize a queue structure to prioritize investors, which simply means that you are in line based on when your commitment was received. For example, let's say we have a need for $50 million and there's $100 million in the queue. What we will do is call 100% of investor commitments up to that $50 million, and everybody else will slide forward in the line. And the question we've gotten the most about the capital call process revolves around the 180-day rule. And investors constantly ask us, will you be able to invest my capital before my gains expire? And the answer to that is, for some, yes, and for others, no. Just to clarify, the 180-day rule means that you have to invest in the fund within 180 days of your gain being recognized in order to get the tax benefits of the QOZ law. Now, everybody's tax situation is unique and different, and there's no way for us to accommodate everybody's situation. So some people's gains are expiring in a month. Some people's gains are expiring in 5 months. Some people have the ability to harvest gains at will. And it's only our ability to put that money to use in a deal that dictates whether or not we are going to call that capital. So from our perspective, we just have to make sure that when we're taking capital from investors, we have a plan to invest that capital. And sometimes it might mean that the asset itself isn't ready for investment for another 4 or 5 months, but investors need to invest in the fund today so that they can lock in the tax benefits of the QOZ law. In those cases, we can actually make an exception and bring capital into the fund under what we call the working capital rule. From an investor standpoint, the investor locks in the gain because the money is actually in the fund itself. And from our standpoint, we're complying with QOZ law because we have a plan to invest that money. Now, any money we take in that is what we deem as working capital won't be earning any preferred return, but it also won't be charged any fees until the time at which that capital is deployed into an investment itself. And we built this mechanism within the fund because we understand that individual investors all have unique tax situations, and we wanted that flexibility so that we could accommodate as many investors as possible in the fund. Now, lastly, we understand that people have options and we may not be able to put your capital to work prior to your gain expiring. In that case, you can actually opt out of the commitment. We're not going to hold you to a commitment. There's no penalty for getting out. We're going to do everything we can on our end to accommodate your commitment, get your money and your capital into the fund. But we have to weigh that with complying with QOZ laws and making sure that as a fund manager, we are staying in compliance with the law. Let me jump now into the returns of the fund. And what I'm going to do here is compare a QOZ investment to a non-QOZ investment. As a bit of background and as a reminder to those who might already be familiar with QOZ law, there are three main tax benefits to a QOZ investment. The first is there's a tax deferral. The second is there's a step up in basis. And the third is that there is an elimination of taxes on any profits generated by the QOZ investment itself. And I'll walk through how each one of these impacts the QOZ investment. What you'll notice at the top of the chart is that the pre-tax fund return is forecasted to be around 14% IRR and a 2.6x multiple on equity. The QOZ investment actually achieves a better return, a 17% IRR and a 3.15 multiple on equity because of the tax benefits. And here's how it works. I'll walk you through the calculus below. If you look at the chart down to the right, what you see is that the QOZ money is on the right-hand side of that chart and the non-QOZ investment is on the left-hand side of that chart. What we are comparing here is the after-tax return analysis of a $1 million QOZ investment versus a $1 million non-QOZ investment. And in both cases, you are using after-tax money to invest. The difference is that the after-tax money of a non-QOZ investment is far less than that of a QOZ investment because the taxes have to be paid right away. And this takes us to the first benefit of investing with QOZ dollars, and that is the deferral benefit of the tax on that capital gain. On the non-QOZ investment, you're only investing $762,000 because the remainder of the $1 million in capital gains has to be paid that year. You have to pay your taxes. In the case of the QOZ investment, the capital gain is deferred until 2026, payable in 2027. So you actually get to invest the entire $1 million. The tax deferral is incredibly valuable. The ability to invest based on the fund performance returns that we're showing here over that 7 years is worth about $400,000. So as we keep moving down and looking now at the non-QOZ side, the profits at the end of the hold period will be subject to taxation. So the after-tax net value is close to around $1.7 million in 10 years, meaning that $760,000 that you originally invested is now worth close to $1.7 million after all of your tax obligations have been satisfied. The QOZ profits, remember, are not taxed at all, so long as you are in the fund for 10 years or longer. So the after-tax value of the QOZ investment is worth close to $2.4 million. It actually generates $700,000 more in gross dollars, which is 70% more profitable on an after-tax basis than a non-QOZ investment. And if you were remotely considering adding private real estate to your portfolio, then the QOZ benefits should help you with that decision. Now, what you're looking at is a 10-year base case projection, and we always hope to achieve this, if not better. There are 1,000 variables that will impact this return, and we've put this together for reference purposes only. What I can tell you is that as a fund manager and as a personal investor in this fund, and my partner is investing significantly as well, we are going to do everything in our power to make sure that we put the right deals in the fund, that we buy them right, that we capitalize them appropriately, that we manage them efficiently, and maximize every last dollar of this fund. Now, I intentionally did not cover the current performance of the fund or the pipeline because those are in constant flux. We have acquired several deals in the fund, and if you want the latest update information, go to our portal. And if you're already registered, you can go in, you can look at the fund updates, educational materials, you can review documents, look at property videos, and if and when you're ready to invest, or if you want more information or to speak to somebody, just contact your personal investor relations contact. You can find their contact information in the portal itself. Now, I'm going to finish up by running through some of the quick details and facts about the fund that I left out that are also very important. This is an open-ended fund, which means we will be raising capital on a continuous basis at various time periods up until the investment period is over, which is at the end of 2021. For the first 2 years of the fund life, the fund share price will remain fixed, and then after that, it will float based on the fair market value of the assets. And the reason why we fixed it for the first 2 years is because value creation will only start to happen as our assets are built and leased. And so for the first 24 months, none of our assets will be in a period of leasing. But after that, as we stabilize these assets, investors who get in later after in 2021 will actually be paying into the fair market value of those assets, and early investor accounts will be marked up to reflect the true fair market value of their account. The fund doesn't have a predetermined life, but the program does end in 2039. We actually don't plan on selling assets at the end of the 10-year period, but we have built in liquidity into the fund so that investors can get out. And we've also built into the fund a provision whereby if a large number of investors want to get out of the fund, say 30%, then we as fund managers are required to sell assets in order to meet that requirement. This structure really provides the flexibility to accommodate the needs of the various investors. Some investors are going to want to stay in for 10 years and a day and get out right away. Some are going to want to stay in for 15, and some are going to want to maximize the tax benefits and stay in through 2039. So regardless, if you're in the camp where you want to get out in 10 years or stay in through 2039, this fund has been designed with that in mind. In terms of fees, there is a one-time upfront admin fee that ranges from 0 basis points to 200 basis points, depending on how much capital you commit. The fund also has a 50 basis point acquisition fee on individual assets when we acquire them. Our asset management fee is 125 basis points per year, and that's based on the fair market value of invested capital. And our performance fee is 15% subject to a 7% preferred return. There is no commitment fee on this fund, so if you are in the queue, you're not being charged. And this largely eliminates a big part of the J curve of investing that you find in traditional PE funds. So that's one of the advantages of not having a commitment fee in a fund like this. So those are some of the fun details. We look forward to partnering with you, and I want to thank you for listening today.